Hey guys, Hexo's M&A spree has continued, having acquired 3 Canadian LPs in the last 3 months. And the acquisition of Redecan is the biggest by far, with the transaction being valued at nearly $1 billion Canadian. With this move, Hexo has now pushed into the #1 position for recreational market share, which is a goal I honestly didn't think they would achieve for years, if ever, considering how far ahead Aphria and Tilray were. As a Hexo shareholder, this news is very exciting, but I want to analyze what this actually means for Hexo going forward, the unique benefits that Redecan provides, and the potential drawbacks that I do see from this purchase, including the nearly $400 million of debt they issued to fund it. I also want to share some of the more important bits of information that I got out of the conference call. As always, this is a long-term focused investing channel, and I always do my best to provide objective and well-reasoned fundamental analysis. If you'd like to skip to any section, there will be timestamps in the description below. Don't forget to like the video if you get some value out of it, and consider subscribing. It's free and you can always change your mind later. I'd love to hear your thoughts on this massive acquisition in the comments below as well. So Hexo is paying $925 million Canadian dollars for Redecan, split into $525 million in new Hexo shares based on a share price of $7.53 Canadian, which is the 5-day weighted average, and $400 million in cash, funded pretty much entirely by the issuance of convertible notes, which is a form of debt that can be transformed into equity. There is also a lockup period in which Redecan shareholders will not be able to sell all of their Hexo shares for 24 months. The transaction is expected to close between July and September of this year. Now, for those of you who haven't heard of Redecan, they are actually the 3rd largest Canadian LP by recreational market share, excluding Quebec. But as a private company, they don't tend to make the headlines as much as some of the other players in the industry. There is no doubt in my mind that Redecan produces great products. As someone working in the industry, I have seen the immense popularity and loyalty, especially to Redecan's pre-roll product, the Reddies, which you can see pictured on the left. In my opinion, this product was certainly a big contributing factor towards Hexo wanting to make this move. The Reddies are a unique product, and no other LP has yet managed to duplicate their qualities or their price point. The quality is extremely consistent, and many people seem to prefer the cigarette style over the traditional conical pre-roll. These are one of the very few products that seem to sell out regardless of the strength of the product, which is rare in an industry usually dominated by whatever is the highest percent. What Redecan has done is essentially retrofit traditional cigarette rolling machines and turn them into low-cost, automated, mass-producing pre-roll machines. This might sound like a simple process, and yet they are still the only ones on the market doing this. The management team behind Redecan has decades of experience in the tobacco industry, and it still took them 2 years of R&D to develop the proprietary technology and process behind this product. Now I want to play a brief clip from the conference call of Hexo CEO Sébastien St. Louis talking about Redecan's technology moat. This is some valuable insight into the unique value that Redecan provides.
The pre-roll capability is not brand. Brand for sure is part of the moat, but this is a technology advantage far and through and above. So the team at Redecan has applied 30 years of tobacco manufacturing experience, and which on its own isn't enough. And then they combine that with some really smart cannabis engineering to produce the Ready products. I've been all over the world looking at this pre-roll technology. Redecan is by far and above the best pre-roll technology that I've seen in the world. And Hexo, by the way, is no slouch. We have some of the best engineering teams in cannabis in the world. We've been trying to figure out pre-roll for years now, and I can say, although we're quite advanced and we're quite good at the pre-rolls we make, we're nowhere near Redecan. They've got a multiple-year lead. And so there's a huge technology lead We plan on cementing that from an IP perspective, so leveraging Hexo's expertise in IP protection to take what are trade secrets and actually patent and protect around it. And then ultimately, in the next 3 to 5 years, I'm sure large tobacco companies will figure out how to apply their current cigarette manufacturing technology to cannabis. But that's a 3 to 5 year lead where, to your point, we need to go build that brand moat, which is why we're investing in the U.S., which is why we want to put this pre-roll technology into the U.S. to build brand there to get ahead of that technology moat starting to falter.
So Hexo believes Redecan has a 3 to 5 year technology lead, and they also believe they can patent certain proprietary parts of the manufacturing process that will further protect this moat. Hexo plans to take this existing manufacturing capability, use it to lower their own production costs, and expand it dramatically, first into Quebec and in the Atlantic provinces, and then eventually into the United States and Europe. This will allow them to be first to market with a revolutionary product in order to hopefully build strong brand loyalty while competitors are still scrambling to respond. Another positive factor is Redecan's growth and profitability. According to their unaudited financial documents, Redecan's gross margins are north of 50%. For some context, in Canopy Growth's recent earnings, they reported Q4 gross margins of 14%, and those were adjusted gross margins. That makes Redecan one of the most profitable and efficient LPs in the industry with positive EBITDA, cash flows, and net income. In fact, Hexo estimates that Redecan's outdoor grow is likely the lowest cost production in Canada, period. Highfire, an industry consultancy and data analytics firm, estimated Redecan's Q1 2021 sales at $58 million, which if annualized would be $232 million Canadian. And this is during a period in which overall cannabis sales have been depressed by extended lockdowns, as shown in all the major players' earnings reports. If accurate, this would obviously be a massive boost to Hexo's revenue and market share. Do keep in mind, though, that since this is retail sales data, the actual revenue generated by Redecan is going to be significantly lower. Given this very limited data, I would estimate Redecan's actual Q1 revenue at around $30 to $35 million, or around $135 million annualized. This would put the valuation of the transaction at around 5 to 7 times calendar 2021 sales. Though as I mentioned, sales may pick up throughout the year as restrictions ease and spending comes back online, so that number might end up being closer to the 4 to 5 times range. If you aren't familiar with the cannabis supply chain in Canada, the licensed producers first sell their product to provincial boards, which then mark up the product and sell it to retail operators, who again mark up the price 25 to 50% and sell them to end customers. The result, including taxes, is a significantly higher retail sales number compared to the actual revenue being generated by the licensed producer. Hexo's management also stated that Redecan has zero debt and a low depreciable capital base. Combined with their very efficient operations, that leads me to believe they have a relatively clean balance sheet and run an asset-light model with minimal plant property and equipment and lean capex. I am very curious to see how much cash is on the balance sheet, however, as this could be a massive factor in determining how good of a deal Hexo got. I doubt this will be the case, but if it turns out Redecan has like 100 mil on their balance sheet, then suddenly this acquisition starts looking a lot more attractive for Hexo. This, however, brings me to the first negative I see with this transaction, and that is the lack of transparency around the financials of the company. Management has been very careful to avoid providing concrete revenue or income numbers and have only provided very minimal tidbits of information like the 50% gross margin number and their estimation that Redecan was one of the most profitable LPs in Canada. We can guess that the financial health of the company is probably pretty good considering that they have no debt, but without seeing the income statement and the balance sheet, I and other investors are unable to value the company. Thus, we can't determine whether the $925 million price tag is fair. They have also yet to give any guidance around cost-saving synergies that would be generated. It appears Redecan was somewhat of a family-run operation and likely didn't keep their books up to the standards of a publicly traded company like Hexo. Therefore, Hexo is conducting an audit, and Redecan's financial statement should be released sometime in the coming few months before the acquisition closes. This lack of transparency is concerning, but in my opinion, it's not a deal breaker. My view is that Hexo saw an opportunity so good that they felt they needed to close the deal before having all the materials and information ready to present to the public. Redecan required Hexo to have the cash on their balance sheet before closing the deal, and Hexo immediately issued convertible bonds. I think this also demonstrates how eager they were to close this deal. I don't want to say they were desperate to lock up this acquisition, but they certainly seemed very eager. As shareholders, all we can really do is trust that management has done all the appropriate due diligence in assuring this will be accretive to Hexo. I, for one, certainly believe management is acting in the best interests of shareholders, and I trust them to make smart M&A moves, but I will reserve final judgment until I see the hard numbers. And that convertible debt issuance is the second negative I see with this transaction. Unlike Hexo's previous M&A activity, which was funded largely by the issuance of new shares, 43% of this purchase is being funded through cash, of which 99% is coming from their newly issued convertible notes. This brings Hexo's total debt load up from around $100 million to nearly $540 million, the majority of that being due in 2 years' time. With $100 million in cash, that brings their total net debt up from near zero to over $400 million. Needless to say, this is a massive jump, and a little concerning to say the least. Management does plan to pay off the Zenabis debt, and I am assuming they will do the same with 48 North's debt as the acquisitions are integrated, but still this leaves them with a much less attractive balance sheet, and raises the very real possibility, or even probability, of additional shareholder dilution through the new issuances of shares to raise additional cash. Now, I want to actually go over the terms of this debt offering. As the primary mechanism for funding this acquisition, it's something that is vitally important to understand, and yet I have barely seen anybody even mention it, let alone go over the details. I've put together a super basic spreadsheet just to help everyone understand the numbers. The structure of this public offering was a little unusual. The notes were sold at 91% of their principal value, netting Hexo $327.6 million, and they mature May 1st, 2023, at which time Hexo will owe 110% of the principal value, or $396 million. These notes do not bear interest, but factoring the 110% principal repayment and only receiving 91% of the principal in the first place, this equates to an annualized premium of almost 10% over the 2-year term. To put it very simply, Hexo received $395 million in cash, and over the next 2 years, they will have to pay their lenders back $475 million. So there's an $80 million difference to make up for, on top of the fact that they've already spent all the cash buying Redecan. I'm not actually 100% sure if they are using the actual principal value or the value of the notes when they were sold, because Hexo lists the debt on their balance sheet as only $435 million, while my calculations put it closer to $477. But for the purposes of this analysis, I'm going to be assuming my numbers are correct. It goes without saying that a 10% interest rate on a $400 million loan would be considered quite high, and in another context might be referred to as junk bonds. The difference here is that the notes are also convertible into common stock, so the purchasers may choose to convert some or all of the outstanding notes into Hexo shares at some point over the next 2 years. The only reason they would choose to do this is if they saw more upside in the shares than the 20% guaranteed premium they'd receive from holding the notes. This would result in significant dilution for Hexo shareholders, around 20% based on the current share price of $8.34 Canadian, and diluted weighted average shares outstanding of 239 million. Though keep in mind this number could become a lot lower if Hexo's share price appreciates. But in my opinion, this is far preferable to the alternative, which is Hexo owing almost $480 million in less than 2 years' time. Frankly, I believe there is virtually no chance that Hexo will be able to generate that level of cash flow from their operations in that time period. Not to mention that they will likely want to deploy additional capital in further M&A related activity, though I don't think it will be nearly to the scale of this acquisition. That would leave them with only two options: either roll over the debt and push the problem into the future, or the more likely scenario, which would be issuing more shares to pay off their obligations. In my estimation, management is making the bet that their share price is likely to be higher in 2 years' time, which would lessen the impact of new share issuance and lead to a very beneficial outcome. For example, if Hexo's stock doubled, then they would only need to issue half as many shares, leading to dilution of approximately 12%. Keep in mind that all of this is on top of the 41% dilution resulting from the 69.7 million new Hexo shares that will be issued to Redecan shareholders. So either way, it does appear that significant dilution is coming. What remains to be seen is if the benefits of these acquisitions will outweigh the costs in dilution to existing shareholders. Overall, I remain positive on Hexo, and there is no doubt that Redecan is an extremely valuable addition to the company. I will, however, reserve judgment on the price paid for Redecan until we get more solid information on the financials. I also believe this is likely Hexo's last major acquisition for a while. Their strategy here is quite clear to me: acquire value-adding companies and integrate them into a profitable domestic cannabis empire, then take those successful brands and products and introduce them into new markets through partnering with existing companies in those markets. This way, Hexo grows internationally in an extremely cost-effective way, similar to a royalty-type structure. They take advantage of already existing infrastructure, supply chains, and relationships. In my opinion, Hexo is in some ways like Sundial, but much better. Whereas Sundial's core business is struggling, arguably dying, and they are making up for this with equity and debt investments in other LPs, Hexo is actually acquiring and integrating quality businesses into their own operations and reaping all of the rewards that come from that vertically integrated structure. Sundial is a capital allocator and an investor, while Hexo is a consolidator of assets and an empire builder. To those of you who made it this far, I want to thank you all for watching this video today. I hope you enjoyed and got some valuable information out of it. Check out my full analysis on Hexo in the description below, and don't forget to subscribe for more quality investing content and analysis. I will catch you all in the next video.